But really, to get a real overview, a bird's eye view, there is nothing better than the State of Nigerian Banking Sector report. This is the definitive guide to the Nigerian banking sector. Such things like what is the state of liquidity? Where are the bad loans versus good loans? What's the performance of individual banks? How do they rank on corporate governance? All these issues are all boiled down, and they indicate the state of the Nigerian banking industry, and they break it down into very small parts. Makes for great reading. Now, this report is in its 12th year, and the 12th year report, we are very happy here at the London Stock Exchange to be the venue for the launch of the latest report. So without much ado, I'd like to call over the architect, one of the architects of the report, to give a presentation on that, and then also to officially launch the report. Please put your hands together for the Chief Executive Officer, Afrinvest, Ike Chioke.
This is not my name. Good morning, ladies. Good afternoon, ladies and gentlemen. It's a real pleasure to be here, and thank you for honoring our invitation to be present at the Nigeria Capital Markets and Banking Forum. We're delighted to be a partner with the London Stock Exchange and the Nigerian Stock Exchange in introducing more Nigerian corporates to the world through the London Stock Exchange. I need to understand how this works. Okay, there. What do I do? Well, it works. My presentation is to talk about a review of the Nigerian banking sector over the last 18 months. It's broken up into 6 sections, where we came from banking performance in 2016, how banks are faring in 2017 year to date, market valuation and performance, the program of economic reforms we've seen, and then outlook for 2018 and beyond. Of course, crude oil. We saw the problem start back in 2014 when oil price began to plummet from above $100 per barrel down to below 50, and then onwards was 22.48 before then trending back upwards. And of course, that had massive effect in terms of monthly crude oil production as well. You saw challenges last year with the militancy attacks on the pipeline. So you saw production volumes also go down from averaging 1.9 million barrels per day to well in the 1.4, 1.3 period. So the combination of falling oil prices and falling production volumes, obviously reduced our quarterly oil export income. So that went down to as low as $7 billion at sometime in the middle of 2016, flipping us into a recession. Our current account balance movement went into negative, and we've come out of that mercifully. At the same time, with that divergence in income and expenses, you saw the widening of the exchange rate environment, with the power market at the top end, and at the point was as much as 200 million naira spread to the interbank market. This is a line on the spread, which has kind of come down quite a lot following the introduction of the investors and exporters window. FX interventions by the central bank has been helpful. They've done mostly more spot sales, but with the, coming out of the recession, you can see that there's more support, and particularly in the BDC market, where they had exited previously, they've come back to support that market to make sure that middle market demand for FX is supported. Since the introduction of the I&E window, we've seen $16.6 billion traded, and the window about $8 billion of that is FPI, which is very good. So back into the banking sector. Looking at the results from 2016, who are the winners? Clearly, from all the performance metrics, GTB stands at the top, because they scored the most number one position out of metrics like total deposits, assets, net interest margin, cost of funds, cost income ratio, PBT margin, return on equity, non-performing loans, cost of risk, and capital adequacy ratio, and followed by Zenith, Access, UBA, and FBN Holding. Then you draw the line, you get to Stanbic, which is actually in our tier 2 category before you get to ETI, which has had some challenges in recent past. Then followed by the tier 2 banks. That's sort of quick snapshot. If you look at the detail, what we've seen is the growing dominance of the tier 1 banks. They've continued to march on to take larger market share. In terms of percentage of gross earnings, you've seen that grow from 71% in 2015 to 73% in 2016. If you look at total assets, they go from 73% in 2015 to 75%. And similar trends, total deposits, total liabilities, gross loans. It's only in PBT that you just see sort of no change. But the tier 1 banks have continued to march on. Of course, the economy is growing, the banking sector is growing, but the tier 1s have far more momentum than tier 2 banks. When you then look in more detail, total balance sheet size, total assets, we see that it's gone up 21% from 2015 to 2016. Where you can see ETI is leading the pack among the tier 1 banks. Bear in mind that Nigeria is only 40% of ETI's business. So it's quite much more diversified than the other top tier banks who have probably no more than 30% in the case of UBA outside of Nigeria. The tier 1 banks are clearly the ones we categorize at 2 trillion naira now up. Once upon a time, the category was only 1 trillion naira, which tells you just the growth in momentum of the industry. In terms of total loans, again, a similar profile. ETI leading, total size of 17.9 trillion in 2016, up 23% from 14.6 trillion in 2015. Total deposits, again, similar trend. A lot of growth there, 19.3%. So you can see, even in a recessionary environment, there are opportunities for growth. Gross earnings, 16.4% growth in the industry. And bear in mind that although we are classifying only 14 banks, these 14 banks in our research represent about 85% of the market, depending on the statistics you're using. Obviously, we have some private banks among the international, Citi, Standard Chartered, that are not in here in terms of this analysis, and a few of the smaller banks like Sky Bank and Keystone Bank that the performance numbers have struggled of late. So ETS still is the industry in terms of gross earnings, but the picture begins to change when you look at profitability. In terms of the composition of sources of income, GT Bank has the greatest non-interest income, and this comes from having a more diverse earnings base with a lot of e-business income and also FX transaction gains. You can see that the tier 1 banks have 32% non-interest income, more, almost 10% spread to the tier 2 banks. Profitability, clearly GT Bank is at the top there with the 165 billion in PBT in 2015. 2016, a big climb from their numbers in 2016. Total profitability was nearly 600 billion naira for the banks under coverage here, up 10% from 2015. In terms of return on average equity, GT Bank is way up there, almost 30% ROA, followed by Zenith, UBA, Access, and indeed UBA and Access have been very sustained performance over the last 2 years. You've seen their numbers climb from, the sort of, 10 to 15% range to now, top, above 15%. Stanbic stands out quite impressively in the tier 2 category in terms of ROA. In terms of PBT margins, again, GT Bank's, better operating efficiency shows up with 40% PBT margin, followed by Zenith, Access, UBA, and then the rest. Stanbic, and of course Union Bank is respectful entrant here. They've really been turn around that bank from the acquisition that was done several years ago. Efficiency ratio, cost income ratio, look at the lowest number here as a better number, and 33% GT Bank is the lowest cost income ratio of the industry. The average is around 50%, so anyone much above 50 is struggling. And you can see some challenges. Access will need to do some work, and so would EcoBank. And the Tier 2 bank, people like Wema and Fidelity have a lot of work to do to bring their cost income ratio in line with the industry. Non-performing loans, again, this is one thing that everybody talks about all the time. The industry NPL ratio is around 12%. The CBN governor has obviously mentioned that, but when you look at it across categories, there are a few, ugly spots. First Bank, 24.4%, end of 2016, although it's trying to come down, but the other one's 9.6 at the ETI. The rest of the Tier 1 category are well below the regulatory limit of 5%. Among the Tier 2 banks, the troublesome spots are pretty much everyone else other than Wema Bank and FCMB, who are above the 5% regulatory limit. Asset quality ratio, cost of risk. Again, cost of risk is impressively lower, UBA, Zenith, and Access. Some issues there for the bigger, more established entity like First Bank and ETI, and also certainly a Unity Bank, but that's not surprising. That's part of the history and heritage you have to digest in that element. So that's the picture of the banking industry in 2016. I'll very quickly take you through how they're doing in 2017 year to date. These numbers are up to September. Tier 1 banks again have increased their share. They've inched up from 73% now to 75% of gross earnings at half year 2017. And the composition shows ETI the largest, followed by First Bank, ETI, Zenith, and then First Bank are the top three in terms of gross earnings. The high interest rate environment has obviously helped boost interest income against non-interest income. We've seen almost a 10% climb in contribution of interest income because of the interest rate environment. Tier 2 banks are facing cost of funds pressure due to the tight monetary environment. Clearly, with a lot of money moving to safer areas, you can see that the cost of funds, just note that the graphs are different ratios. The Tier 2 are going from 0 to 10%, while the Tier 1s are going from 0 to 6%. Clearly, Tier 2 banks have a much more challenging cost environment in terms of the cost of funds. Cost income ratio ranking, talked about that. Even at the half year number, GTB continues to sustain a very low cost income ratio, and it's kind of coming off there in terms of the average. But you can see that for the tier 1 banks, their cost income ratio is about 9% lower than the Tier 2 banks. So this is again part of the advantage of being in the large category. Size does matter in this case. And in terms of PBT ranking in 2016, half year number 101 billion naira. GTB has made a big jump from the 30.7 billion, but they had taken provisions of the same time last year, followed by Zenith Bank and UBA 57, quickly Access at 52. So indeed, some of the PBT numbers that the Tier 1 banks are printing is almost as much as the revenue of the Tier 2 banks, again, showing how divergent the industry is. And return on average equity, return on average assets. And here again, the numbers speak for themselves. The GTB and Stanbic IBTC are the top 27%. And indeed, their valuations show, as you'll see in the next few slides, followed by Zenith, UBA, and Access in that order. Non-performing loan cost of risk. Certainly some work needs to be done at the First Bank to sort out the balance sheet in terms of the asset quality. also ETI, but the rest of the tier 1 group are okay. And among the tier 2 banks, things look okay, except maybe you see warning signs of Diamond Bank and Union Bank. Capital adequacy ratio remains above the prudential limit for across all the tiers. Systemically important banks have to maintain 16% capital adequacy ratio, and indeed all of them are doing that. And then the non-systemically important banks, they are required to do above 10%. So all in the clear so far for the universe we cover. Valuation. All the tier 1 banks have delivered positive returns in 2017, clearly on the back of opening of the investors and exporters window. We've seen quite a massive flow of FPI, and that has supported the uptick in the market with the all-share index up 36%. The banking index is actually almost up about 40%, and all of them have registered varying degrees of success in that order. UBA, for instance, is up 96% for the year, so done very well for investors who went into that stock. But everybody is done really quite handsomely among the tier 1 banks. Tier 2s, not so good. Only Stanbic, Fidelity, and Diamond have performed well. Sterling and Union Bank as well. The rest have actually been in negative despite all the positive news, and underscores the, again, investor sentiment. People clearly want to just stay with the big guys and the good boys and stay well away from troublesome spots. You can see how the index has performed quite superior to the banking index, to the overall market index. Almost a big 20% jump there. This is a bit hard to see. It just shows you market valuation of the banks driven by return on equity. So you can see the ones that have higher return on equity have higher valuation, no doubt, with GTB and Stanbic at the top end with the price to book value in the 2 times region, and then suddenly the rest of the pack, Zenith at 1, and then everybody else below 1 time. By the time you go past the rest of the tier 1, most of the other banks are at 0.5 times price to book value. So there's a huge valuation premium that banks are leaving on the table, and people always ask me, how do you explain the difference, particularly between someone like GT Bank and Zenith? Because their performance is very similar. They make about the same 100 billion naira PBT now at the half-year mark. And the one reason I can suggest maybe it could be the degree of transparency, the perceived degree of transparency. Maybe GTB being listed on the London Stock Exchange and the main board helps. But there's a real big premium that's on the table there. There's almost doubling the size of GTB relative to Zenith Bank. But when you look at Nigerian banks' valuation relative to Sub-Saharan Africa, you can see that the average is 0.9 times price to book value. That's the first column, compared to Ghana, 0.8 times price to book value. If you go to Egypt, the industry there is valued at 2.1 times, Kenya 1.7, Morocco 2.0. So it still tells you that even with all the upside we've witnessed in Nigeria in recent times, we're still quite below the average for our region. And when you compare it to BRICS region, we're still below, underscoring the message that there is opportunity in the market, and because there's more upside. As the economy corrects, you'd expect the banks to do stronger earnings, which if they maintain the same valuation threshold will mean that their own multiples will come down. So underscoring greater opportunity for investors. So on the back of the turnaround you see in the market, we want to just profile some of the current reforms the government is doing in key sectors. In the power sector, we've seen that following the privatization of the power industry starting in 2013 going to 2014, it all started like a positive, but we entered a bit of a traffic jam with inadequate infrastructure, power infrastructure, non-cost reflective tariff. We have the MITRE 2 tariff pricing regime, but we've not kept up with all the assumptions. The exchange rate has moved obviously from 199 to 305. It hasn't been reflected. Inflation has moved. hasn't been reflected. So that's posing issues for all the players in the industry. There's still significant aggregate transmission, commercial, and AT&C losses. There's also a huge metering gap. Lots of customers are complaining that they're being charged far more than they consumed, and there are not enough meters to go around. Even when you talk about prepaid meters, gas supply shortages continue to plague the industry, even creating challenges for companies such as Seven Energy, who have invested quite a lot in the market to supply gas, but the payments have not caught up. And some of the issues of 2016 has also caught them on the wrong foot. And of course, the value chain illiquidity. The central bank is obviously helping out here, and they've announced a broad range of measures to kind of help unlock the traffic jam we see in the power sector. And that's something, if we can fix, will very much stimulate every company in Nigeria and further drive the opportunity and growth we see in the country. In the oil and gas sector, you saw the Minister of State announce late last year the 7 big wins in terms of managing stakeholder engagement, transparency and efficiency, policy regulation, gas revolution, refineries and local production capacity, as well as the business environment drive. Around all of that, obviously, Niger Delta security. That was very important last year, because last year, we had situations of incessant blowing up of our pipelines. So for about half of the year, many of the oil majors couldn't export. But that's been all fixed, and it's important that that piece is maintained and sustained, so we can then go to the bigger task of ensuring a more open environment in the oil sector. But the elephant in the room is that the big bill has been talked about, the petroleum industry bill, has still been talked around. 10 years into the making and discussion, we have not come yet closer to getting it passed. And until we actually reform that key industry, we will not get out of this boom and busts challenge, like you saw in my very opening slide. When oil prices go up, people in Abuja focus on something else. When oil prices go down, we come to a conference to talk about diversifying the economy. In agriculture, there's a lot of work, and I have to give credit to this government for a very dogged effort, and indeed the central bank for their support of that sector. We've seen they've taken, I call it, you never waste a recession. They've taken the challenges of 2016 and really pushed further and deepened the agricultural sector. We'll see the commercial agricultural credit scheme, which is supported by the central bank, the Nigerian incentive-based risk sharing for agricultural lending, again CBN supported, the Anchor Borrowers Program, CBN supported, the Growth Enhancement Support Scheme, CBN, and the Presidential Fertilizer Initiative. And all of these things have all catalyzed to creating an industry that today is printing millionaires across many states in Nigeria. Taraba State Governor Baseki is here as a testament to that, and he's even going to be doing more in pushing for more investment in the agri sector, because this is really where I think 40% of the GDP of Nigeria is agri-based, and this is really where we can get employment back into the country and be able to find work for the teeming youth of the country. Ease of doing business is another area that the government has tackled. Improvement in transparency in MDAs. I mean, it's talked about. A lot still needs to be done. I mean, some issues like in the oil and gas sector remain like a big tiff between the Minister of State and the DG, and the GMD of NNPC is an example of not quite enough transparency. But we do expect that as government continues to make more progress in that area, it would help create a more enabling environment for Nigeria and attract more investment. The entry experience for visitors has improved. We now have visa on arrival. It's not quite as easy going to most tourist destinations in Africa, but at least it saves you the time you need. And if indeed you are going to be a guest at the Edo State Investment Summit, it will be quite possible to get you into the country within 24 on arrival with all the paperwork known in advance. Ease of registration of business is improving. Efficiency in the ports, well, that it kind of goes back and forth, but there has been effort and commitment to improve that even better. And all of this is all sort of various plans of government that feed into the economic recovery and growth plan, which is riding on 5 pillars: stabilizing the macroeconomic environment, achieve agriculture and food security, improve transportation infrastructure, ensure energy sufficiency in power and petroleum products, and drive industrialization, focusing on SMEs. I think on the very first pillar, we have the CBN governor to thank. And may I just applaud him for his work in stabilizing the macroeconomic environment. On the second pillar, agriculture and food security, the momentum is there and it's growing very well, and we're quite excited. We just need to sustain it. And the challenge, though, is that as the exchange rate comes down and regularizes, it means that the cost parity for Nigerian farmers is being lost. When there's a high sort of a depreciated naira, it means the Nigerian agricultural products are actually much cheaper and easier to export, and they earn foreign exchange. But there has to be strike a balance, and I think as we make more investments in large-scale farming, lowering costs, improving efficiency, even at a stable environment, a stable macroeconomic environment, you'll see a lot of success in the agri sector. Transportation infrastructure is clearly one area we need to work on. The cost of moving goods around in Nigeria is exorbitant, to say the least. Actually, if you move a container from China to Lagos, it's cheaper than moving the same container from Lagos to Onitsha. And that just captures how expensive it is. We do need to do a lot of work in rails, roads, and other ways of getting things around. In the energy, I've talked a bit about the power sector and the petroleum sector. There's a lot of work in terms of reform that still needs to be done. Again, these are areas that are considered to be low-hanging fruit. If you can reform the sectors, you can probably add that 5 to 10% GDP growth you're looking for is just right there. It's just locked up. As soon as you can fix those sectors, will be easily in the 10% GDP growth year on year. And that's what you need in order to get to the last pillar, to drive industrialization, and particularly focusing on the SMEs. So, outlook for the economy, looking beyond 2018. As you look at 2018 and 2019, you can't but stop to look at the political environment. We have an election cycle coming. We have increasing public debt. We also have security challenges. On the political side, will he or will he not? The big question is, obviously we have a lot of government officials, and I won't put them on the spot by asking them this question, but as a private citizen, I can take my own chances. If Buhari comes back to run, then that's a question mark for the political landscape. But one thing is clear, that both the APC and the PDP have zoned the leadership, that's the presidential ticket, to the north. So whether it's a Buhari or perhaps someone from the PDP camp who are trying to reorganize themselves, we don't have this issue of zoning, which is a perennial problem whenever we have election cycles. But the political one is an issue from a macroeconomic environment because of the spending you see that happens around elections. And so the challenges for some of the policy actions of government is that when would they sort of take their foot off the ball and divert the spending to perhaps non-beneficial activities, rather than focusing on infrastructure in the long term. The CBN governor talked about the public debt area, and it's one for concern. Although Nigeria's debt to GDP is low at 19%, Nigeria's debt service revenue is very high at 60+%, and that's really one of serious concern. How we get our tax revenues up, like PwC mentioned, is a critical one. Thanks, Andrew, for that intervention. But it's really one that we have to watch out for, the increasing public debt. It's all very well to talk about moving some of the debt offshore and rebalancing so that you don't have as much crowding out of the private sector within the domestic economy, but be mindful that over the long term you have the challenge of potential devaluation, and that debt overhang could take us back to discussing with the Paris Club and the London Club in not too distant future. We have to be careful. And of course, security remains a challenge. In the security area, we've got, spots of, challenges all over the regions. In Northeast, Boko Haram is beaten but not out. Southeast has their IPOB agitation, which has been quelled and closed down for now. South has a typical, usual Niger Delta militancy. Southwest, the largest clamor for restructuring, but luckily of the economy. North Central, we've got the Fulani headsmen, castle, creating tension, of course, castle rustling and religious pressure points in the Northwest. So the security challenge is one that indeed lends credence to the issue for restructuring. From Afrinvest research perspective, I think the main issue is the economic opportunity for the average Nigerian. The center cannot hold. And at some point, you have to find a way to free some of the states to do more and get the economy to trickle down to the average Nigerian. I've talked about the political environment, what could happen, what could not, and then just to step back and look at the global risk considerations for Nigeria. Some of the systemic central banks have taken normalizing their interest rate environment that has potential risk for Nigeria. Bull case, base case, and bear case scenarios for oil price environment. We think that on balance it will still be in the base case, the bull case area, maybe trending between 50 to 60. So that would be kind of positive for some of the plans and programs of the government. We're not too worried about some of the implications for Glass-Steagall globally. Closer to home, though, when you look at our macroeconomic trends, oil prices, we think the outlook at 60 is benign, is helpful for Nigeria. Production could keep on trending towards the 2.2 million barrels per day region. At the monetary policy side, when you look at the interbank, we're not suggesting there's a devaluation, but this is a 380 is the position of the non-deliverable forwards at the moment, the 12-month threshold. So clearly that's already priced in into the market in terms of what people are looking over 12 months from now. We think there could be some easing, so we'll see perhaps as we look for how to bring growth into the system, the CBN may consider bringing interest rates down to the 13% region, and we see year-end inflation coming off again because of the high base effect of food prices. They just released the draft budget for 2018, but the expenditure framework suggests the spending is positive, deficit to remain within the legal limits, but the challenge will be how to fund the deficit. But all on balance, we're looking at an annual GDP growth of above 2.5% in 2018. And so our crystal ball for the banking industry, asset quality to continue to improve from a weak base, of course stronger at the tier 1 banks and the tier 2, resilient growth in gross earnings, a slower pace of loan growth, profitability margins to be supported by a lower cost of risk, tier 2 banks to come out to raise more capital to shore up their balance sheet, sustained preference for investment securities will remain as you see the momentum of interest income over non-interest income, and Eurobond issuance to continue. You've seen Fidelity Bank come out and issue, although it's a tough deal, at $400 million. In fact, as recently as 3 months ago, people are telling me not to bring any tier 2 issue to London, but Fidelity has clearly opened the window, and would expect to see more of those banks coming. So on behalf of that, ladies and gentlemen, thank you very much.